Today, black swans and green swans. The Property Imperative Weekly to the 20th of January 2020. Hello again, I'm Martin North from Digital Finance Analytics, working with the latest post covering finance and property news with a distinctively Australian flavour. In our latest weekly digest, we look at the market action, starting with the US, but if you want to jump to the Australian section, the code is shown below. Nassim Nicholas Taleb wrote about the concept of black swan events in his book, The Black Swan, The Impact of the Highly Improbable, back in 2008. He argues the world is severely affected by events that are rare and difficult to predict. But people develop a psychological bias and collective blindness to them. The very fact that such rare but major events are by definition outliers makes them dangerous. While we all want to know the future, we can't. We can model and predict some things to an extent, but not the black swan events, which creates psychological and practical problems. No computer program can forecast it away. Markets can be clearly too high or too low, but reliable, accurate forecasts you can bank on are just a fantasy. And we are surrounded by swans at the moment, given global developments so far this year. Traders have already gotten crash courses in diverse fields, from climate science to Middle East relations to US constitutional law. Now, this week has forced traders to get up to speed quickly with epidemiology as the coronavirus hit centre stage, with China extending travel restrictions for more than 40 million people in an attempt to halt contagion, as the World Health Organization deemed it an emergency in China, having now killed more than 26 people and infected more than 1,000 on the eve of the Lunar New Year holiday. By the end of the week, markets were reacting, overshadowing positive corporate US earnings. The fear factor is the risks of contagion, synonymous with what happened in 2003 with SARS, which led to a 2% drop in Chinese economic growth. The widespreading virus is the latest challenge for a market that's been buffeted this year by geopolitical turmoil in the Middle East and North Africa, as well as the Phase 1 trade deal between Beijing and Washington. The virus jitters were most prevalent in energy, as stocks slumped after oil prices fell sharply on concerns about weaker aviation fuel demand amid a stumble in tourism and air travel. And at Davos, the Bank for International Settlements spoke about green swan events, which are even more complicated and difficult to navigate, and amid fears that a further spread of the virus may dent global growth. See my post, Climate-related risks are a source of financial risk, says the BIS. In New York, all three major US stock indices extended their losses after the Centers for Disease Control and Prevention confirmed the second case of the virus on US soil, this time in Chicago. There's not much confidence in actual fundamentals, and a scare like the virus can be enough to force investors to rethink if markets have run too far, too fast, for too long. The Dow Jones Industrial Average fell 0.86% to 28,989. The S&P 500 lost 0.9% to 3,295. And the Nasdaq Composite dropped 0.93% to 9,314. The Volatility Index rose 12.1% to 1456, reflecting greater market uncertainty. In fact, there is an increasing amount of call buying for the VIX that expires in the middle of February. The betting would suggest that some traders see a surge in volatility in the weeks ahead. It could serve as a strong indication that a pullback in the S&P 500 is quickly approaching and over the short term. This despite the fourth quarter reporting season, with 75 companies in the S&P 500 having reported and 68.2% having beaten their expectations. That accounts combined to 19.4% of the index total market capitalization. These earnings of the 75 indices members were down 1.3% from the same period last year on 3.2% higher revenues. but investors will be scrutinising the quarterly reports for strong forward guidance. A bigger proportion of the banks are unable to beat EPS estimates thus far, likely indicating that earnings estimates, particularly for the banks, may have been on the high side. The market appears to have accepted the deacceleration in growth this year in the hope that growth will resume next year. But Intel Corp surged 8.3% after reporting jumps in data center and cloud computing revenue and forecasting better than expected 2020 earnings. It closed at $68.47. American Express benefited from a robust US retail sales environment, posting a better than expected 9% annual revenue increase, and its stocks advanced 2.3%. But Boeing added to waves of selling and slipped 1% on the report that the aircraft maker was mulling further cuts to its 787 Dreamliner production. It closed at $323.05. Following the turn in sentiment, financials came under pressure as investors snapped up treasuries, pushing yields sharply lower. The T30 fell 2.18% to 2.135. The T10 fell 3.06% to 1.686, while the 3-month slid 1.64% to 1.531. The Fed had flooded the market with $410 billion in liquidity between September and January the 1st through its repo operations and its T-bill purchases. But now, according to data this week, while T-bill purchases continue, the repos on the Fed's balance sheet are getting unwound. Its mortgage-backed securities continue to fall, and total assets on its balance sheet fell to the lowest level since mid-December. So liquidity support looks to be slowing. Total assets declined by $30 billion over the 7-day period to $4.146 trillion. And this is down by $20 billion from the balance sheet 4 weeks ago, back on December the 25th. The slump in bond yields will tend to keep a lid on net interest margins at the banks, with some of the main names like JP Morgan, Citigroup and Goldman Sachs closing more than 1% lower on Friday. Goldman, in fact, was down 1.49% to 241.92. The dollar climbed against its rivals on Friday as data showing ongoing strength in the US services sector offset a continued slowing in manufacturing to a 3-year low. The IHS Markit Flash Purchasing Managers Index for manufacturing slipped to a 3-month low in January, but the services PMI rose to the highest level since last March. The Euro-US dollar was down 0.24% to 1.1025, while the US dollar index futures was up 0.2% to 97.88. In the UK, the PMI flash beat on both manufacturing and services, with the manufacturing report printing at 49.8 versus 48.9, which was expected, while the services rose to 52.9 compared with 51 forecast. The rise reflected fresh optimism in business after the Brexit saga was finally resolved, suggesting a surge in pent-up demand that should improve growth in the first quarter of 2020. However, after an initial pop higher, sterling reversed course, dropping to 1.307, down 0.37%, as traders continue to bet on the possibility of a UK rate cut. And more losses could follow when trade negotiations between the UK and the EU begin after the UK leaves the trading bloc on January the 31st. The FTSE was up 1.04% to 7,585, shaking off black swan fears for now. Banks followed with the FTSE financials up 1.04% to 784.89. The chief executive of Royal Bank of Scotland's digital bank, Market Bailey, is leaving the state-backed bank within months. Bailey, an RBS veteran and former chief operating officer of the bank, led development of digital bank Bo, which only launched officially in November last year. His departure could be confirmed alongside RBS's full-year results on February the 14th, when CEO Alison Rose is expected to announce a new strategy for the bank. Rose, who stepped up to the top job last year, has already cleared out the management team at the lender's underperforming investment bank, NatWest Markets, with both the CEO and the CFO of that division stepping down last month, and Bailey was seen as a potential candidate for the RBS CEO role before Rose was appointed to the job. RBS was up 1.96% to 223.40. The Eurozone economy seems to be on the mend, with Christine Lagarde recognising a modest improvement in underlying inflation, as she continued to expand on the idea that whilst downside risks remain, they have diminished. Germany's flash PMI was better than expected, but the strikes in France weighed on the service sector and was a drag on the aggregate reading. Germany's manufacturing PMI rose to 45.2 from 43.7, while still obviously below 50, it is at its best level in 11 months, and has edged higher in 3 of the past 4 months. The service sector remains resilient and improved to 54.2 from 52.9. The composite rose to a 5-month high of 51.1 from 50.2. New business grew for the first time in 7 months, and manufacturing orders saw the smallest decline in 15 months. The French manufacturing PMI rose to 51 from 50.4, but the services PMI fell to 51.7 from 52.4 and was a larger decline than expected. The composite PMI eased to 51.5 from 52. And the EMU aggregate manufacturing PMI rose to 47.8 from 46.3. It is the highest since last April. The service PMI fell to 52.2 from 52.8. Many Asian markets are closed for the Lunar New Year, including China. The onshore yuan market is closed, but the offshore market, the yuan, has softened a little to bring this week's losses to a little more than 1%, the largest decline since last September. It closed at 6.9367. Gold futures was up 0.36% to 1,571 in a flight to quality, as you might expect, while oil headed for its worst weekly slump in more than a year amid fears that China's coronavirus will cripple fuel demand, just as markets struggled with a fragile world economy and adequate supplies. Crude oil for delivery in March fell 2.5% to 54.20. Goldman Sachs said earlier this week that if the coronavirus has an impact similar to the 2003 SARS epidemic, demand could be curbed by 260,000 barrels a day. Finally, Bitcoin was at 8,465, up 0.7% on Friday. Hi, it's Liz's interruption, but if you're getting value from this post and have not done so, please consider subscribing to this channel or ring the bell for custom alerts. Plus, please consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or subscribe via Patreon for as little as $3 US a month or more to get access to exclusive additional content. Alternatively, you can also donate using Bitcoin. Here is the QR code. The links are in the comments below. I really appreciate your support, which enables us to continue to make more great content. Thanks very much. Now, back to the current show. And so, to the local market. Australian consumer pessimism deepened in January as households fretted about the economic impact of the devastating bushfires that killed 29 people, millions of animals, and destroyed thousands of homes in recent months. The Melbourne Institute and Westpac Bank Index of Consumer Sentiment, released on Wednesday, fell 1.8% in January to the lowest since October. It declined 1.9% in December. The index was down a hefty 6.2% from a year earlier, and at 93.4 indicated pessimists continued to outnumber optimists. The free fall in sentiment bodes poorly for consumer spending, and it could hit growth in Australia's $1.9 trillion economy in coming quarters. Economists generally expect the bushfires to drag on gross domestic product by somewhere between 0.25 and 0.4% per quarter through the year. All the economic components of the index recorded declines in January. The Economy Next 5-year subindex fell 3.7%, while in the Economy the Next 12 months subindex slipped 5.4%. Both are down 8.9% and 11.9% respectively. The direct impact of the fires have so far been felt mainly in rural townships, though hazardous smoke haze has hung over the bigger cities of Sydney and Melbourne, plus Canberra, hitting tourism and spending. Businesses are also feeling the heat, with fashion retailers and food and beverages makers reporting a slowdown in sales, and more retailers are shutting the doors. For example, German giant Kaufland announced an orderly withdrawal from Australia despite sinking more than $500 million of investment. And data from both NAB and ANZ on transaction throughput in December suggests the retail numbers will be pretty weak. The latest Commonwealth Bank Flash Composite PMI signalled a continued decline in business activity in January. In fact, the latest fall in output was the sharpest since the survey began in May 2016. New orders and employment increased, however, thanks to improvements in the service sector. The rate of input cost inflation softened again to a 9-month low, but companies raised their output prices at a sharper pace than in December. And they say that the start of 2020 pointed to a third successive monthly decline in business activity in the Australian private sector. Output decreased modestly, but to the greatest extent in the 45 months of data collection so far. Sharper reductions in output were seen across both manufacturing and the services sectors. And the Australian Tourism Export Council has estimated international tourism revenue in 2020 could fall by 10% to 20%. And we estimated the financial impact of the bushfires on tourism in our post, How Bushfires May Impact Tourism. The impact could be $30 billion or more over 3 years. Turning to house prices, CoreLogic released their latest pain and gain report, which revealed that more than 1 in 5 apartments were sold at a loss across Australia's capital cities over the September quarter. This is consistent with our estimates. The unit sector is still under pressure, and it's impacting kids, according to Deakin University research, who found that high-density living is harming children's well-being. The number of families living in apartments increased by 56% between 2011 and 2016 censuses. Despite its growing popularity, there is evidence this type of housing is not meeting the needs of Australian families. The city of Yarra is a Victorian municipality that has had a 6-fold increase in the number of apartments over the past 10 years. And a household survey found residents in high-density areas of the municipality were less satisfied with their neighbourhood as a place to raise children. They found that parents had difficulty accessing local schools and childcare, and further supports the argument that private high-rise housing in Australian cities has been designed without considering children as residents. And CoreLogic also reported on auction clearances over the December quarter, saying the combined capital cities clearance rate came in at 70.3%, from 26,923 auctions, a significant jump on the previous quarter, where auction volumes were 16,730 and returned a clearance rate of 69.9%. The clearance rate is remarkably higher than the December 2018 quarter, when the clearance rate was 43.6%. So it'll be interesting to see what momentum looks like after the holidays. Their index continues to run hard with rises in all centres this past week. However, the rate of growth continues to slow, and of course we are still below the previous peaks in most major centres. But as I continue to point out, this index is not helpful to understand what is really happening, as different areas and different types of property are behaving very differently. And News.com agrees with a new map, revealing the truth is more complicated than the headline index may suggest. Sydney is not just one market, they say. Like the stock market, it has parts that are going well and parts that are going terribly. Not all Sydney homes are the same, and depending on what you own, you're potentially still in the middle of that housing downturn that supposedly stopped a year ago. The map shows Eastern Sydney home prices are up 12.6% in the last year, but units have performed differently, and if you bought a unit in southwest Sydney, you can expect to be worth 3.5% less than a year ago. And this week, Simon Singh, a leading consultant based in Melbourne, claimed that valuations for Melbourne house and land packages are still coming in at 5 to 20% below their purchase price, with at least 30% of buyers in some areas experiencing negative equity. We are witnessing anywhere between 5 to 20% undervaluation of properties in Melbourne, and at least 3 out of 10 buyers in the area are battling lower valuations because most of them purchased at the peak of the property boom, said Mr. Singh. Off-the-plan buyers who aren't able to settle risk losing their deposit and in worst case can also open themselves up to a potential lawsuit from the developers. And we see negative equity in our survey data too. Mortgage momentum was stronger in recent months, according to Australian financial group AFG, who released their housing finance data for the December quarter. It registered a strong annual bounce in the number and value of mortgage applications, but they have slowed more recently. The number of mortgage applications fell by 1.9% over the December quarter, but surged by 18.9% over the year, whereas the value of applications fell by 1.8% over the quarter, but surged 12.1% over the year. And this is consistent with our analysis based on the ABS data. Migration, of course, remains elevated. This is quantitative easing by the back door and an attempt to keep the GDP positive. The per capita data is more negative. But former Liberal MP and Gosford Mayor Malcolm Brooks has attacked Australia's policymakers for encouraging, quote, unchecked population growth, claiming that it is destroying our quality of life, and saying unchecked population growth will have a dramatic impact on our quality of life, and our politicians seem to be oblivious to this fact. Without adequate planning and government action, our unchecked population growth also threatens our limited water supplies and makes the risks of running out of water more likely. Where will our additional water supply come from, he asks. The overpopulated Sydney Basin won't have enough for its own needs. With population growth and climate change placing increased stress over our limited water supplies, but there appears little political will, federal, state or council, to manage population growth or to recognise the limitations of our available water supplies. This, I think, is because there is a fixation on growth at any cost, and it's masking the human and social consequences that no one wants to discuss. Once again, we're in black swan territory. And so to the markets. At the close in Sydney, the ASX 100 gained 0.05% to end at 5,879, having hit new highs this week, but then adjusted down as the virus scare developed. The first confirmed case in Australia, by the way, has just been announced. The ASX Financials was up 0.31% to 6,264, while the ASX 200 VIX, which measures the implied volatility of the S&P ASX 200 options, was down 1.67% to 11.95. Among the banks, ANZ rose 0.58% to 25.90. CBA closed at 84.94, up 0.05%. NAB lifted 0.43% to 25.80, despite Australian law firm Maurice Blackburn filing a class action lawsuit on behalf of more than 330,000 account holders against two entities of National Australia Bank for alleged breaches in pension laws. The lawsuit was filed in the Supreme Court in Victoria. This is another regrettable case of mismanagement in the superannuation sector, said Andrew Watson, National Head of Class Actions at the law firm. He said the lawsuit would centre on NAB's failure to transition more than $6.3 billion of default member balances to a lower cost product in a timely manner. And last month, Australia's securities regulator took the country's third largest lender to court, accusing it of inappropriately taking fees from financial planning customers. Westpac rose 0.52% to 25.21 as it named banking veteran John McFarlane as chairman, entrusting the former Australia and New Zealand banking group boss to help steer it through the fallout of a massive money laundering scandal. The appointment comes less than 2 months after the bank got embroiled in the scandal and at a time of wider gloom for Australia's Big Four banks following the damaging revelations from a government-backed inquiry into financial sector misconduct. McFarlane, who was the chairman of British bank Barclays until May last year, will assume charge on April the 2nd and oversee the search for a new CEO, the lender said. But Australia's Big Four banks are bracing for yet another year of pain after a string of scandals and damaging revelations from the government's inquiry into financial sector misconduct. And it doesn't stop there. As well as the actions against AMP, who rose 0.54% to 1.86, Macquarie's chief executive and her predecessor are among 60 present and former staff to be named as suspects by German authorities as Germany's biggest post-war fraud probe into sham trades unfolded. German prosecutors and tax authorities are seeking to recover billions of euros from traders and banks that prosecutors say profited from such schemes. The country estimates the schemes cost it more than 5 billion euros in total, although some estimate the damage might be twice as high. Macquarie acted as a lender to a group of funds involved in the share trading in 2011 and has previously said that it was one of over 100 financial institutions involved in this market, from which it withdrew in 2012. On Thursday, Macquarie said the amount at issue was not considered material and it had provided for the matter. Macquarie ended up 0.59% to 145.86. And the shares of CIMIC, formerly known as Leighton Holdings, Australia's largest construction company, plunged 20% on Thursday to a 4-year low, wiping $2.2 billion off its market value, following news that the company was abandoning its Middle Eastern operations with the sale of its stake to BIC Contracting. The firm expects to suffer a $1.8 billion charge-off after failing to recover debts owed for the project built, or in some cases barely built at all, at the tail end of Dubai's property bubble. CIMIC builds many of Australia's biggest infrastructure projects, including Melbourne's $6.7 billion Westgate Tunnel and Sydney's Metro City. It is also the world's largest contract miner. The company is majority owned by German construction giant Hortief, which itself is majority owned by ACS, the world's 7th largest construction and services company by sales, following its acquisition of the German firm back in 2014. CIMIC's stock has plunged 44% since April. The Aussie US dollar was down 0.31% to 68.25, while the euro dollar was up 0.1% to 1.6155. The Aussie Bitcoin cross was up 0.96% to 12,440, and the Aussie Gold cross was up 0.88% to 2,301. So the black swans are swarming, to mix my metaphors. Thus, the accuracy of estimates and predictions are as much a matter of luck and intuition as of skill and sophisticated modelling. Black swans nullify even the most complex modelling. Now, this does not mean modelling and prognosis cannot be or should not be done, but we also need to rely on intuition, common sense and simplicity, and my feeling is the next few months will be a doozy. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.